Hello and welcome to the series of the question solving for CMA US part 1, where we are solving the questions for few of the chapters for section A. So which all chapters are covered over here? It is being mentioned in this table. Let's start with the question solving without wasting much time. So in this video we are gonna solve 32 questions altogether, and you guys stay with me and we'll solve each question step by step, and we will not only identify the correct answer but also we will see and understand that why other options are incorrect. Let's start. So question 1 is saying which of the following best describes the primary purpose of the balance sheet, that is why the balance sheet is actually prepared. Option A, to show the results of a company's operation over a period of time. Is balance sheet prepared over a period of time? No, income statement is prepared over a period of time. So it's not the correct answer. Option B, to present a company's financial position at a specific point in time. Is balance sheet prepared at a point in time? Yes, correct. So that is why option B is going to be our correct answer. Let us see why option C and D are incorrect answer. So option C says thus to summarize the sources and uses of a company's cash during a period. Is this the correct answer? No. Why? Because option C is talking about the statement of the cash flows. Then coming to the option D, to reconcile the beginning and ending balances of retained earnings. So why option D is important? Is not the correct answer, because option D is talking about the statement of changes in stockholders' equity and not the balance sheet. Now, if I am going in the examination, if I am approaching this question in the exam, what will be my approach? What I will do? I am seeing that primary purpose of balance sheet and I am seeing 4 options. And at the end of the second option, I am seeing it is written point in time, and balance sheet is something which is related to point in time. I will just read this particular option and I will be pretty sure that yeah, this is my correct answer. But to be on the safer side, I'll just quickly go through the rest of the options, option A, C and D, in order to solidify that our option B is the correct answer. Moving on to the question number 2. Question 2 is about a company's balance sheet reports assets and liabilities primarily at historical cost. Which of the following is a valid criticism of this practice during a period of significant inflation? Now, as we know that all the assets and liabilities on the balance sheet are reported at historical cost. That is, for example, if I bought a land 5 years ago for 50 lakhs, today in the market the value of that particular piece of land may be 1.5 cr, but still on my balance sheet it will be valued at what? It will be valued at 50 lakhs. So what the question is asking, that since we know that assets and liabilities are reported at a historical cost, so what is one of the criticism that during the period of inflation, that is when the prices are rising, what we are doing, we are recording this at a historical cost. So what is going to be one of the criticism? So let us understand each and every option. Option A says reported net income tends to be overstated because expenses are understated relative to the current replacement cost. What does that mean? Reported net income tends to be overstated. That means net income is higher. That means if the net income should have been 100, it is being reported at 150. That is what overstated means, because expenses are understated relative to the current replacement cost. I'll take very basic example in order to confirm whether this is my correct answer or not. Now suppose I have a machinery for which what I am doing for that machinery, I have purchased that machinery 5 years ago at 10,000 bucks, but today the replacement cost of that machinery is 30,000, but I am charging the depreciation at 10,000 at the lower cost, at the historical cost. So my depreciation amount will be lower. Depreciation is an expense which is showed on the income statement and it directly impacts my net income. So if my depreciation expense is lower, what will be happening? My net income will be higher, it will be overstated. So that is why option A is the correct answer. Now let us see why option B, C and D are incorrect. Option B says reported net income tends to be understated because revenues are recorded at current prices. So is option B correct? No. Option B is wrong because revenues are recorded at their actual transaction date price and not held down artificially. So income is not understated for that reason. What does that mean? That revenues are recorded at the price, that means the day revenue has been recorded and is at the current price, that means at the its actual price. So there is going to be no scope of recording the net income on the lower side or maybe on the higher side. That means net income will be fine. So option B is not the correct answer. Coming to the option C, total assets will be overstated relative to their current market value. What does that mean? That means it says that as it is recorded at historical cost and during inflation, total assets will be overstated relative to their current market value. Is this correct? No. Why? Because during inflation, prices are rising. If prices are rising, that means the actual cost of assets should be this, but we bought it beforehand and we are carrying it at the historical cost. So the cost of the asset, the total assets are already lower. There is no scope of assets being overstated. So that is why option C is incorrect. Coming to option D, total liabilities will be overstated relative to their settlement value. Option D is also wrong. Why? Because liabilities, they are usually carried at the amount which we actually owe to our creditors. So that is why option D is also incorrect. Moving to the next question, question number 3. All of the following are considered limitations of balance sheet except that it relies on this. What are the options? First of all, before having a look at the option, we should be very careful when we are reading the question in the exam. The except word is clearly mentioned in caps. And what is the question saying? All of the followings are considered limitations of the balance sheet except. That means most of the options, all of the options are limitations, are disadvantages of balance sheet except one of the options. So we need to see which of the option is not a limitation of balance sheet. Okay, let's understand. Option A relies on estimates and management judgment for items such as allowance for doubtful accounts. Yes, this is one of the disadvantages about which we have studied in the balance sheet chapter. So this option is one of the limitations of balance sheet and this is not our option because we have to find an exception to the limitation. Then option B generally does not reflect the current value of long-lived assets. Correct. Why? In the previous question only we saw that we carry the assets at the historical cost. We are not carrying it at the replacement cost or it's at its fair value. So again, this is also what one of the disadvantages or limitations of balance sheet. Option C excludes internally developed intangible items such as brand reputation or a skilled workforce. Correct. If we have a very good customer loyalty and if our employees are very good, we cannot value these particular qualitative factors and show it on our balance sheet. So again, this is also one of the limitations of the balance sheet. So I am seeing that okay, option A, B and C is a limitation, is a disadvantage. All these are disadvantages. So automatically option D will become my correct answer. But let's read and understand and then justify and mark this as our answer. Option D says reports the liquidity position of the company by classifying assets and liabilities as current or non-current. So what it is saying, that it reports the liquidity position of the company. That means how easily company can sell off its current assets in order to get it in order to repay its current liability. So can we easily understand about it? Yes, with the help of a balance sheet. Why? Because we clearly bifurcate, we clearly show what is current asset, what is current liability, what is non-current asset and what is non-current liability. So this is actually one of the strengths or one of the advantages of balance sheet. So that is why this is an exception to the limitation and option D is the correct answer. Moving to the next question, question number 4. Nova Traders reported the following account balances at year end: cash, accounts receivable, prepaid rent, land held for future use, inventory or equipment, accounts payable and notes payable. Everything is given over here. Now what amount should Nova report as total current assets? Let's use our calculator. So guys who are solving along with me in the session, or who are watching this video and they are also carrying their calculator, let's solve this together. Question is simply saying what are total current assets. Just we have to focus on the current assets. Is cash a current asset? Yes, cash is a current asset. Then next, accounts receivable. Is accounts receivable a current asset? Yes, accounts receivable is a current asset. Then prepaid rent. Prepaid rent is kind of a prepaid expense. Is this a current asset? Yes, this is a current asset. Then land held for future use. Is land a current asset? No, land is a non-current asset. So this is not to be included. Then comes the inventory. Is inventory a current asset? Yes, inventory is a current asset. Then equipment. Is equipment a current asset? No, equipment is a long-term non-current asset. So again, this is also not a part of our calculation. Then accounts payable is a current liability. Notes payable due in 18 months. Though it's due in 18 months, but again it's a liability, non-current liability. So again, what is our answer? 81,000 is our answer. So 81,000 is our total current asset. Coming to the question number 5. Question 5 is about which of the following characteristics best describes the financial flexibility as it relates to a company's balance sheet. Okay, this question is quite important. We might get confused between two options in this question. I'm giving you a heads up. This might happen with us in the exam also, that we might feel that two options could be correct for a particular question, but what we have to do, we have to choose that particular option which is relatively more accurate in that particular scenario. Let's understand. This question is asking about us the financial flexibility. Acha, what do we understand by financial flexibility? Financial flexibility in the layman's term means that we should have enough money in our accounts, in our bank accounts, or maybe we should have enough cash in a business, that if anything comes out of the blue, if any sudden activity or maybe sudden scenario comes up, so we are able to tackle that without hampering the rest of my activities, like without hampering the repayment of rest of my current liabilities. So that is what is financial flexibility. Now let's see. Option A, the ability to convert assets to cash quickly without significantly loss of value. Is this option correct? Yes, it is somewhat correct, but I want to have a look also on the other options. Option B, the ability to take effective actions to alter the amounts and timings of the cash flow so it can respond to the unexpected needs and opportunities. Is this option correct? Yes, this option also looks correct. Let's see option C and D. The ability to meet its short-term obligations as they come due. The ability to meet short-term obligations is directly related to the liquidity. Option C is not correct. Option D, the ability to meet its long-term obligations as they mature. Is this correct? No, this is also wrong. Why? Because long-term obligations is related to the solvency. So again, option A and option B. Let us see. Option B is sounding more apt for the financial flexibility. So why? Because again it is talking about the unexpected needs and opportunities. It's also talking about to take the effective actions to alter the amounts and timings of cash flows. So that is why I feel option B is more accurate. Coming to the next question. Question number 6. Very important, guys. Let's focus on this. Question 6 is talking about Bramwell Company shipped goods to a customer, FOB shipping point on December 29. The goods were still in transit at year end. Due to a clerical error, the goods were not removed from Bramwell's ending inventory count and the sale was also not recorded until the following year. Which of the following correctly describes the effect of this error on Bramwell's year end balance sheet? Okay. First of all, in order to understand this question, we will be more easily able to understand this question once we are done with the inventory chapter. But again, since we are, I don't know if many of you would have already watched the inventory video or not. But again, for those who have not, watched the inventory video, I'll explain to you like as simply as possible. So when I am sending goods to my customer, when I am selling goods to my customer who is located in another city or maybe another country, where I am sending the goods via courier, so there is going to be two scenarios usually. One is FOB shipping point, one is FOB destination. What is FOB? Free on board. It's a terminology. Let's just understand. When it's the case of FOB shipping point, what happens? As soon as the goods reaches the shipping point, that is, suppose I am sending the goods to a customer based out in Hong Kong, and I am sending the goods via Kolkata. Like, there is my shipping courier, there is DTDC service, they are providing, like they are being the person who people who are going to deliver the goods to the customer. I am handing over the goods, the shipping point is Kolkata. I have given the goods from my warehouse and handed it over to the common courier at Kolkata at the shipping point. So if it is FOB shipping point, on that particular day, that inventory will not be recognized in my book. It will not be recorded in my books. It will be recorded in the buyer's books. And to counter again, like how to then again, there should, for a debit there should be a credit. So again, if the inventory is being recorded in the customer's books, then what we need to do? We need to record a sales and we need to show a cash, maybe cash receipt, or maybe we need to show accounts receivable, right? So what we need to do, we need to do this thing, that whenever it is FOB shipping point, as soon as the goods are being given over to the common courier, what we will do? We will do what? That we will just simply record the inventory on the customer books, or maybe we will remove it. Just to simplify, we will remove it from our books of accounts, but we will show an equivalent sales or accounts receivable in our books. If it is FOB destination, so in the case of FOB destination, the goods will be recorded in my books, in the seller books, until and unless the goods are delivered at a destination. The customer takes the possession of the goods. We hand over the goods to the customer. Okay. Now, what the question is saying, that I sold the goods to the customer as FOB shipping point on 29 December, and the goods were still in transit at year end. That means the goods were still on the sea, on the ocean, when they were being sold to the customer. But it is FOB shipping point and it has been shipped to the customer on 29 December. That means on that day I should not record that inventory in my books of accounts, in my balance sheet, and I should record a accounts receivable. Now, due to a clerical error, there was an error. The goods were not removed from Bramwell's ending inventory count, and the sale was also not recorded until the following year. That means we have not removed that particular inventory from my balance sheet, and also I have not recorded the sale as well. So what I will do, how this particular like what the question is saying, which of the following correctly describes the effect of this error on Bramwell's year-end balance sheet? First of all, inventory should have been removed, but we did not remove it. It is again, this inventory should have been at this level. So inventory is what? Inventory is overstated, right? So either option answer will be option A or option C. Then the second part of the question says the sale was not recorded until the following year. That means this year we did not record the sale. Okay, when I am recording the sales, I will record accounts receivable debit, 2 sales, accounts receivable debit, 2 sales, right? But I have not recorded sales only. So that means I have not recorded my accounts receivable. I have not recorded my accounts receivable. So my accounts receivable is what? Understated. So that is why option A is the correct answer. Why? We did not remove the inventory, so inventory is overstated, and we did not record the accounts receivable, so accounts receivable is understated. Simple. Okay, next, coming to the question number 7. The going concern assumption underlying the preparation of financial statement presumes that. What is the going concern presumption? The going concern, not presumption, sorry, assumption. It assumes that the business is gonna exist for forever, for an indefinite period of time. That is the assumption of the going concern. Now, what are the options given over here? The entity will generate positive net income in each of the next 3 fiscal years. No. Is it for a particular fixed number of years? No. Then the entity will continue to operate for the foreseeable future without the need or intent to liquidate. Is this correct? Yes, this is the correct. Why? Because it is talking about the foreseeable future without the need or intent to liquidate. That is why this option is correct. Now, option C, the entity's asset will always be reported at their current liquidation value. Is this option C correct? Yes, option C is not correct. Why? Because it is talking about recording the this assets at current liquidation value. Do we do that? No, we record the assets at its historical cost. Then the entity has no outstanding debt that could force it into bankruptcy. Does this mean anything related to going concern? No. So again, this is not the correct answer. Option B is our correct answer. Coming to the question number 8. Question number 8 is quite interesting and one of the important questions. Why? Because we have already done this concept in the class, and if you guys remember that there was a concept that if we have two bank accounts, in one bank account there is a positive balance, in one bank account we have overdraft, and both are in different banks, then we cannot net those balance together and show it together. But if both the balances are in the same bank, in the same maybe account, then what we can do, we can club them together and we can show it together. So in different banks cannot club. If in the same banks and maybe same kind of accounts, then we can club it together and show it as one balance. So this particular question is based on that concept. Now, a company maintains two operating checking accounts at different banks, not at the same banks. At year end, account 1 has a positive balance and account 2 is overdrawn by 6,000. Overdrawn means what? Overdraft facility we have used. Now there is no right of offset between the two accounts. It's clearly mentioned in the question. So how these balances should be reported? Again, positive balance, so it should be shown as cash of 22,000, and the one which is overdrawn, again it should be shown as a current liability. So that is why straightforward. The correct option is answer B. Okay. Coming to the next question, which of the following is most useful in evaluating a company's solvency using information from the balance sheet? Solvency is related to short term or long term? It's related to the long term obligations. Let's see. Option A, the current ratio. How do we calculate the current ratio? Using the current assets and current liabilities. So is option A correct? No. Why? Because option A is related to calculating the liquidity. Then option B, the relationship between total debt and total assets. The total debt and the total assets, it is related to meeting the long term obligations of the company. Long term obligations is directly related to the solvency. So again, option B is the correct answer. Option C, gross profit percentage. Is gross profit percentage correct answer? No. Why? Because it will not help us understand the solvency, the company's ability to meet its long-term obligations, to repay its long-term debts. We cannot identify with the help of the gross profit percentage. So again, this is not the correct answer. Then the number of days sales in inventory. Is this correct answer? No, because we cannot measure that with the help of this, that how you will how often you will turn over your inventory, or how often your inventory will convert into sales. That's what option D is talking about, and that is nothing related to the solvency. Question 10. Halcyon Corporation classifies a $500,000 note payable due in 8 months as a long-term liability at year end because before the balance sheet is issued, Halcyon enters into a valid non-cancellable refinancing agreement to convert the note into a 5-year term loan. Under US GAAP, this classification is, if you guys remember, if there is a particular liability which is about to mature, but we have an intent and an ability to refinance them or to convert that particular current liability into a non-current liability, then in that scenario what do? We record it as a long-term liability, we record it as a non-current liability. So that is why recording this 500,000 note payable as a long-term liability will be correct. Why? Because Halcyon entered into a valid non-cancellable refinancing agreement to convert the note into a 5-year term loan. That means they already made this this agreement before the balance sheet issue date to convert that particular note into a long term 5-year term loan. Now Coming to the correct answer will be either B or C. But let's see what does option B is talking about. Only if the refinances agreement was executed before the original balance sheet date. No, before the original balance sheet date, there should be the intent and ability. Both the intent and the ability should be there. And we have this thing over here in this particular case. Even in this case, it is a non-cancelable refinancing agreement. So it's for sure gonna happen. So option B is not the correct answer. Coming to the option C, because the company has demonstrated both the intent and contractual ability to refinance a long-term basis before the financial statements are issued. So that is why option C is the correct answer. Question number 11. Which of the following would not typically be used by an external investor analyzing a company's income statement? So, what should not be typically be used by an external investor while analyzing a company's income statement? What they will not use? So, first of all, company comparing current period revenue growth to prior periods. So, first of all, let us identify what will be used by the external investor in order to decide, like if you are an investor and you want to invest money in a business. So, what all you will analyze before putting your money in that business. Apart from that, out of these options, if any of these things which you will not do as an investor, that is gonna be our correct answer, because question is what, like not typically be used by an external investor. Option A, comparing current period revenue growth to prior periods. Comparing current period to prior period, is this correct? Yes, because as an investor I would like to know that how my business, how that not my business, how that particular business in which I am planning to invest is doing, whether it's doing good or not. Then assessing the trend in the operating margin over several years. That means I would like to see how is the operating profit of that particular business, that I would like to analyze. So again, option B is not the correct answer. Then option C, determining the exact cash balance available for a stock buyback. What does a stock buyback means? Company is going to go in the market and buy back its own share. So as an investor, will I be interested in knowing how much cash this company has in order to buy its share back? No, I will not be interested for that. Then coming to the option D, comparing gross margin to industry peers. So that means I am comparing the business in which I am planning to invest, that company's gross profit margin with the other companies in the same industry. So will I do that? Yes, I will do that. So again, option A, B and D shows clearly denotes all those activities which an investor, an external investor would like to do before investing in a company. So that is why A, B, D are not the correct answer. C is the correct answer, because that is something which I am not gonna do. Then question number 12. Meridian Corporation sold a piece of manufacturing equipment that had been fully depreciated for financial reporting purposes due to originally underestimating its useful life. The sale resulted in a material gain. How should this gain be reported on Meridian's income statement? Now there was a equipment which was fully depreciated. That means the book value of that particular equipment has become zero. Why? Because we underestimated its useful life. The life should have been 20 years, but we just, for example, we just only estimated to be 10 years and we depreciated it really soon, and because of that after 10 years the book value of that equipment was zero, but the actual value is not zero, the resale value is not zero, and when we sold off that particular asset it resulted in a material gain. That means a good amount of money we made. Okay, so how should that be treated in my income statement? As an extraordinary item net of tax below income from continuing operations. First of all, is it a part of income from continuing operations or discontinuing operations? It's a part of an income from continuing operation, because only equipment we are discontinuing. We are not discontinuing a whole business division. So that is why option A is not the correct answer. Then option B, as a part of income from continuing operations. So under US GAAP, extraordinary item classification has been eliminated. So again, arising from an originally underestimated useful life discovered upon sale is reported within income from continuing operations. Like it's a kind of an extraordinary item, but again the US GAAP has eliminated that particular rule, and that is why any such transaction will be reported as an income from continuing operations. Option C, as a direct adjustment to the beginning balance of the retained earnings. So is this correct answer? No, it's not a correct answer. Why? Because we adjust the balance, beginning balance of retained earnings in that scenario when there was an adjustment in a previous year which we missed to do, or which cannot be done last year, and we want to adjust it this year. So again, because last year's net income will be added to the retained earning, and last year's closing retained earning will be this year's beginning retained earning. So what we are doing, we are adjusting the retained earnings this year in order to make an impact of the calculation, or maybe any error which we made in the last year. So is this related to something like that? No. So again, option C is that's why not the correct answer. Option D, netted against depreciation expense in the period of sale. So what we are doing, we are again netting it against the depreciation expense in the period of sale. Is this correct option? No. Why? Because sale ke against we do not net anything. We have never seen anything like that. So that is why option D is also not the correct answer. Question number 13, very important, very easy. All of the following are elements of the income statement. What all do we report on income statement? Revenue, expenses, gains and losses. Option A, B and D. So anyways, option C will be incorrect. Why? Because comprehensive income is not a component of the income statement. Balki comprehensive income is a sum total of net income and other comprehensive income. So that is why option C is the correct answer. Now, okay, coming to the question number 14. Question number 14 is about Falkirk Industries has a calendar fiscal year. What does that mean? It has a calendar fiscal year. That means its fiscal year, financial year is one and the same thing. Starts from 1st December, ends on 1st January and ends on 31st December. So 1st January to 31st December is the fiscal year. On April 1 of the current year, management committed to plan to sell its industrial coating division, representing a strategic shift with a major effect on the company's operation. That means they're planning to discontinue one of the units. That's what it explains, because it's clearly showing industry management committed. That means they have the intent and the ability and they're reasonably sure to execute it. Industrial cottage division, representing a strategic shift with a major effect on the company's operation. For the period January 1 through April 1, the division had revenues of 2.4 million and expenses of 2.95 million. So Jan 1 to April 1, what is the revenue and the expenses? That is given. The division was finally sold on October 15 at a loss, for which no tax benefit was available. How should Falkirk report the division's operating results for January 1 through April 1 on its current year income statement? Now, first of all, what will be our net profit or loss from this? So the revenue is 2.4 million and the expense is 2.95. So let us do the calci. Okay, I have just used the wrong number. 1 2 3 4 5 minus 5,50,000 is going to be my loss. So this loss should be shown where? So this 5,50,000 of loss, it should be shown as income or loss. First of all, it's a loss, so it should be shown as a loss from a discontinued operation. Why? Because why it is showing as a discontinued operation? Because in that particular year we have decided to discontinue it and we even actually sold it off. So that is why it should not be a part of a continuing operations. Question number 15. Under US GAAP, where should a company report the loss from disposal of a major operating segment that qualifies as a discontinued operation? So under US GAAP, where should a company report the loss from disposal of a major segment that qualifies as a discontinued operation? First of all, it should always be shown as a net of tax, because discontinued operation, they are always showed net of tax. So option A and C are automatically incorrect because it is talking about pre-tax. So again, option B or D, net of tax, in separate section between income from continuing operations and net income. Is this correct? Yes, because income from discontinued operation is shown right after income from continuing operation but before the net income. And option D is incorrect because it is talking about as a direct adjustment within accumulated other comprehensive income. Do we show discontinued operation over there in OCI? No, we show the discontinued operation on our income statement only. Coming to the question number 16. Quantum Devices reports first quarter revenue of 8 million, a gross profit margin of 40,000 and operating expenses of 2.4 million. Management is evaluating outsourcing the part of production which should reduce the cost of sales percentage to 55% of the revenue without changing the sales volume or operating expenses. If implemented, what should be the impact on gross profit? Let me open my notepad so that there I can do the question. Okay, let us do the question over here. Question is talking about the revenue. Revenue is given to us as 8 million. Then gross profit margin. Gross profit margin or gross profit percentage is how much? It's 40%. And it is given operating expenses of 2.4 million. Management is evaluating outsourcing the part of production which would reduce the cost of sales percentage to 55% of revenue without changing the sales volume or operating expense. Now the question is asking what would be the impact on gross profit. So first of all, before any outsourcing, what is the profit? So if I take the profit, so profit will be 8 million into 40%. What will be the 8 million into 40%? It will be 3.2 million. If you do the calculation, you will get the same answer. The question is talking about management is evaluating outsourcing which would reduce the cost of sales percentage to 55% of revenue. So the cost of sales percentage. So from revenue when we reduce the cost of sales, we get the gross profit. Okay, we get the gross profit. Now again the question is talking about what the question is talking about. The question is talking about that the cost of sales percentage is reduced to 55% of revenue without changing the sales volume or operating expense. So my new cost of sales is 55% of the revenue. 8 million ka 55%. So how much it should be? Let me do the calci. I think it should be 4.4 million, but again I'll just double check. 2 3 4 5 6 into 55%, it is 4.4 million. So this is 4.4 million. And what is my profit? My profit is 8 minus 4.4. 8 minus 4.4, so it comes to 3.6 million. So what is happening? 3.6 million. So previously my profit was 3.2 million. After that outsourcing, my profit has become 3.6 million. So there is a 0.4 million increase in profit. My gross profit has happened what? My gross profit, what has happened to my gross profit? 3.6 minus 3.2. What has happened? 0.4 million is the increase in my profits. Okay. Now, I hope this is clear to you guys. Then, moving to the next question. Question number 17. According to FASB, the conceptual framework, revenue may result from... we are seeing in the last portion of all the options, major or central operations, peripheral transactions. These two words are only mentioned. So revenue is a part of a central operations or a peripheral transaction. What does first of all major or central operation or incidental or peripheral transaction means? Major or central operation means what actually the business does, what is the purpose of the business, what it actually does on a day-to-day basis. Whereas incidental or peripheral transaction means what that has happened out of the blue, that has happened suddenly. So again, is revenue an incidental or peripheral transaction? No. So automatically automatically option B and D I have eliminated just by seeing these two terminologies, because the question is talking about the revenue. Then option A and C, now we should have a look. So option A is talking about a decrease in liability arising from an entity's ongoing major or central operation. Does revenue arises out of decrease in liability? Yes, revenue arises when there is an increase in asset or a decrease in liability. So that is why option A is going to be my correct answer. Is option C correct? No. Why? Because option C is talking about a decrease in an asset. Is decrease in asset will cause a revenue? No. So again, that is also not a correct answer. Question number 18. Harbourline Incorporation sells a fixed asset with a net book value of 18,000 for 30,000 cash. That means there was an asset, the value of that was, book value of that asset was 18,000, but I sold it for 30,000. That means I sold it at a 12,000 profit. Then in the same period, we paid an outstanding bond interest of 12,000. So 12,000 was the interest on the bond, and there is going to be a dividend of 25,000 for which we did not pay yet, but it was a declared. So what is the net effect of these transactions on Harbourline's income statement for the period? Acha, first of all, do we record the dividend on the income statement? No, we do not record the dividend on the income statement. So again, this is irrelevant. Do we record this 12,000 of interest payment on outstanding bond or income statement? Yes, I will record it as an expense. Then the gain on the sale of that asset of 12,000, will I record this? Yes, this will be recorded as a gain. So 12,000 ka expense and 12,000 ka gain. So what is my net impact? My net impact on my income statement is 0. So that is why option A is our correct answer. Now question number 19. Question number 19 is about a company's income statement is least useful on a standalone basis for which of the following purpose? That means in which of the following scenarios, when we are individually using the income statement, it will be useless for us. Option A, evaluating trends in operating performance over multiple periods. Can we use income statement in order to evaluate multiple periods like the operating performance? Yes, we can use just the income statement for the previous years and for the current year in order to evaluate that, the operating performance. So option A is incorrect. Then option B, assessing the precise amount of cash generated by operating activities during the period. So is this option correct? Yes. Why? Because if we want to know what is the exact amount of cash that was generated by operating activity, where we'll get that? We'll get that from the statement of cash flows. Then again, option B is the correct answer. Coming to the option C, comparing profitability to industry competitors. Can we compare a profitability to the industry competitors? That means, can we compare it? Yes. Why? Because with the help of our just income statement and another company's income statement, we can do that comparison. Coming to the option D, assessing risk associated with the variability of a company's earnings. So can we assess the variability of that, how volatile that particular companies this will be, earnings will be, with the help of the income statement? Yes, because income statement shows almost all of the line items which are which present all kinds of revenues and expenses for a business, and with the help of those line items we can easily identify which of this is risky. So again, option D is also not the correct answer, and that is why option B is correct, because if we want to know the cash generated by the operating activities of a business, we should refer to the statement of cash flows. Then question number 20, which of the following would be included in other comprehensive income rather than net income? So which of this will be included? So let us see. First of all, what all will be included in net income? That means that item will be reported on the income statement. Option A, loss on sale of equipment. Where it should be recorded? It should be recorded on an income statement. So this is not the correct answer. Option B, unrealized holding gain on available for sale debt securities. Where do we record unrealized gains and losses? Obviously on my comprehensive income, on my statement of comprehensive income. So option B is the correct answer. Option C, interest expense on outstanding bond. Where do we record this? Again, on my income statement on the debit side. Then option D, loss from our discontinued operation. Where do we record this? We record this on our income statement. So that is why option B is my correct answer, because rest of the options we recorded on my income statement. Question number 21. Silverleaf Corporation reports the following for the year: net income, unrealized gain on available for sale debt securities, foreign currency translation adjustments, adjustment loss, dividend paid, and proceeds from issuance of cost, and all of these. Now it is asking what should Silverleaf report as its comprehensive income. First of all, what is my comprehensive income? Comprehensive income is the sum total of my net income and my other comprehensive income. Let us use our calculation. What is the net income? Net income is my 1.4 million. Then unrealized gain on available for sale debt securities. Is this a part of a comprehensive income? Yes, this is a part of my other comprehensive income. So this 65,000 is what? It's a gain. So again, it should be what? It should be added. Then foreign currency translation adjustment loss. This loss is what? This loss should be reduced. Why? Because this is recorded on my income statement. Oh, sorry, this should be recorded on my other comprehensive income. Then dividends paid. Do we record dividends paid in comprehensive income? No, it should be recorded on the it should be reduced from my retained earnings. So this should not be recorded. Then proceeds from issuance of common stock. Should we record this as a part of my comprehensive income? No. Why? Because comprehensive income, in that we have net income and OCI, and in both the net income and OCI we don't have proceeds of issuance of common stock. This goes under the equity stock or the common stock category. So again, what is the correct answer? 1.447 million is the correct answer. Question number 22. Which of the following statements about accumulated other comprehensive income is correct? Which of the following statement about accumulated OCI is correct? AOCI is close to net income at the end of each fiscal year. First of all, is AOCI a permanent account or a temporary account? It is a balance sheet account, so it's a permanent account. It's never closed. So option A is incorrect. AOCI is a component of retained earnings on the balance sheet. Is AOCI a component of balance sheet? No, it's not a component of balance sheet. It is actually a separate line item under the statement of the stockholders equity. So again, that is also not the correct answer. Option C, AOCI is a separate component of the stockholders equity that accumulates OCI items until they are reclassified into net income or otherwise removed. Is this correct answer? Yes, this is the correct answer. Why? Because AOCI, accumulated OCI, is what? It is the collective, it is the collection of all the other comprehensive income that we have accumulated over the years, and they are be reclassified into what? They are be reclassified into net income, or like unless and until that OCI item is either reclassified into net income or it is completely removed, it will stay where? Under the AOCI. So that is why option C is the correct answer. Option D, AOCI appears only on statement of cash flows. Is it correct? No, AOCI is never reported on statement of cash flows. It is reported under the equity section of the balance sheet. Question number 23. A company may present comprehensive income using one of the following formats under US GAAP. How do we present comprehensive income? First of all, we have two options. Either we are going to present it in a one single continuous statement in the along with the income statement, or we will have two separate statements, but they will be consecutive statements, one after the another, where in the second statement the first line will be the net income. So which option is correct? Option A, only as a single continuous statement combining net income and OCI. Is this correct? No, this is not correct. Then option B, only as a part of the statement, as a part of statement of changes in stockholders equity. Is this correct? No, again, this is not correct. Then option C, either as single continuous statement or as two separate but consecutive statements. Is this correct? Yes. Why? Because we can present the comprehensive income either as a single statement or two separate consecutive statements. So this is the correct answer. Then option D, only within notes to financial statements. So is this correct? Yes, this is the correct option. Why? Sorry, no, this is not the correct option. Only option C is the correct, because we do not show the comprehensive income under the notes to financial statements. Coming to the question number 24. Question number 24 is talking about Ashgrove Company reported the following items: the sales, the cost of goods sold, operating expenses, unrealized loss, then reclassification, adjustment of gains included in net income is given, 15,000 income tax rate is given. What is Ashgrove's comprehensive income? It is talking about the comprehensive income. So let us see what will be its comprehensive income. Okay, so first of all, what is comprehensive income? Comprehensive income is net income plus OCI. First of all, let us see what is the net income. So if I calculate the net income, let me first calculate the net income. I will take the revenue 5.2 million. From this, I will subtract the cost of goods sold. Then what I will do? I will do subtraction of the operating expenses as well. Okay, so this much is my net income, and from this I need to do what? I need to reduce the tax rate also. So 25% is the tax rate, so that means 75% of this 9 lakh is my net income. 9 lakh is coming to be my net income, and the question is talking about the OCI, the other comprehensive income. So from the other comprehensive income, what we should do? From the in the net income we should add the comprehensive income, other comprehensive income. So unrealized loss available for sale debt securities, that means from this we should do what? From this we should reduce what? We should reduce, just a second, first of all I'll just make a note of this. Yeah, I'll just make a note over here. So my net income is coming to be, right, this is my net income. Now what the question is saying, the question is asking about my comprehensive income, and comprehensive income is what? Net income plus OCI, right? And what will be my OCI? My OCI, my other comprehensive income will be what? 40,000. 40,000 is my loss, right? 40,000 is my loss, right? 40,000 is my loss. 40,000 is my loss, and 15,000 is my what? 15,000 is my gain. 15,000 is my gain. So what will happen? Reclassification including net income for securities hold. So that means we are reducing that as well, right? We are reducing that as well. So what we are going to do? We are going to take this 40,000, right, this 40,000 of unrealized loss, then reclassification adjustment for gains included in net income from securities sold during the year. That means we are reclassifying, we are removing that from where? From our this particular line item. From where? From our this comprehensive income. So that means in that, if I total 15,000, so 55,000 should be removed. If 55,000 should be removed, so that means my OCI should be what? Okay, this should not be 5,50,000, this should be 55,000. So what I should do? 9 lakhs minus 55,000 will be 8,45,000 is gonna be what? 8,45,000 is going to be my comprehensive income. Acha, why are we reducing this also, reclassification? Because we are not including this gain as a part of my not part of my OCI. We are moving it, we are reclassifying. Reclassifying means moving from one place to another. So we are going to include it in my net income. So that is why we are double counting it. That is why we are reducing it. Now, question number 25. Which of the following is the best rationale for reporting certain gains and losses in other comprehensive income rather than net income? That is, what is the reason that why we report certain types of gains and losses in other comprehensive income rather than in net income? That means we are recording it, we are parking it in the other comprehensive income, and we are not immediately recognizing it in our net income. Option A, to simplify the calculation of earnings per share. Do we do that because of that reason? No. Then option B, to defer the recognition of item until it is realized, reducing the volatility in reported net income from items outside management's core operating performance. So what happens? What we are doing when we are parking anything in OCI, we are deferring it. That means we are delaying the recognition of a particular item in order to what? In order to ensure that my net income is not fluctuating a lot because of any such item which is not directly impacting us, or maybe not impacting us straight away. So that is why option B is the correct answer. Why option C and D are incorrect? Option C, to avoid the need to disclose the item anywhere in the financial statements. Are we doing that to avoid the need? No. Again, this is wrong, because OCI items, they are fully disclosed on the other comprehensive income. They are not hidden. They are just removed from the income statement. They are not included as a part of the net income. Then option D, to eliminate the item permanently from all financial statements. So why do we do that? Is this the correct answer? No. Why? Because OCI items, they are never ever eliminated. They remain in accumulated OCI within the equity section of the balance sheet. So again, D is also not the correct answer. Question number 26. The statement of changes in stockholders' equity primarily provides a, what does it provide? The listing of the fair value of all outstanding equity instruments. Is this correct? No, it does not provide any fair value of any equity instrument. Then option B, reconciliation of the beginning and the ending balance of each individual equity account. Is this correct? Yes, this is the correct option. Then option C, computation of diluted earning per share. Is diluted earning per share is calculated with the help of statement of changes in stockholders equity? No, we can calculate it even if this particular statement is not prepared. Then option D, summary of only the retained earnings account activity. Does stockholders equity contains only summary of retained earnings? No, not at all. So again, option B is the straight away the correct answer. Question number 27. Colvin Corporation began the year with retained earnings of 2.3 million. During the year, net income was 6,40,000. Cash dividends declared were 1,50,000, and the company recorded a prior period adjustment correcting an understatement of depreciation expenses in a prior year of 45,000. What is the Colvin's ending retained balance? Ending retained earnings balance. Very simple. Let us open our calculator and we will simply do it over there. Folks who are doing along with me in the class, you guys also can open your calculators and do it along with me. So the question is talking about that we need to calculate the ending retained balance. The beginning retained balance is given to us as 2.3 million. Then what is the net income? Net income is given to us as this much. Then cash dividends, what is the dividends declared? The dividends declared is 1,50,000, and the company recorded a prior period adjustment correcting an understatement of depreciation expense in a prior year of 45,000. What does that mean? That means last year we did not record a depreciation expense. There was an understatement. That means we should have recorded 45,000 more, but we didn't record that much. So whenever we miss to record any expense, any gain in the last year, we adjust adjust it in the current year's retained earnings. So this expense would have done what? If the expense would have been more, the profit would have been lesser. Lesser amount would have been added in my retained earnings. So my retained earnings is also overstated. So we have to do what? We have to correct it, and we are gonna do what? We are gonna reduce it with this amount, 45,000, and 2.745 million is the correct answer as per our calculation, and also over here it's given. Now, question 28. Notes to financial statements serve primarily to, that is, what is the reason why do we prepare notes to financial statement? To replace the need for a separate balance sheet. Does notes to financial statement does that? No, because it does not replace it, it rather it complements the balance sheet. It helps us to understand it even more easily. Then option B, provide additional detail and context necessary for users to understand amounts presented in the primary financial statements. Yes, that's what the notes to financial statement does. It provides a detailed detailed context and necessary it helps us to understand the amounts presented in the primary financial statements. Then option C, disclose only information required by the income tax authorities. Does notes to financial statement record that? No, it does not record that. Then option D, present forward looking non-audited management projections. Does notes to financial statement record that? No, it does not record any of that. The only reason why we prepared notes is because of the option B, and hence that is the correct answer. Question 29. Which of the following would typically be disclosed in notes to financial statements rather than presented as a line item on the balance sheet? That is, which of these will be, like, if the question is clearly saying that which of these should be typically disclosed in the notes to financial statement rather than presented as a line item of the balance sheet. So what all will be the balance on the balance sheet will not be our correct answer. Will current liabilities will be a part of my balance sheet? Yes. So again, this is not the correct answer. Option B, a summary of significant accounting policies such as the inventory costing method used. Will this be a part of my balance sheet? No, this will not be a part of my balance sheet. This will be clearly a part of my notes to financial statement. So option B is the correct answer. Option C and D, they are clearly a part of a balance sheet. They are the line items in the balance sheet. So that is why option C and D are not the correct answer. Coming to the question number 30. Question number 30. Ferngate Co. reports the following equity balances at the beginning of the year. Common stock, APEC, retained earnings, accumulated other comprehensive loss is given. Now during the year, the company issued additional shares of $300,000. Net income is given and dividends declared is given. And the company recorded other comprehensive income of $22,000. What is the stockholders' equity at the year end? Now, let us open our calculator and this question will be solved on the calculator. First of all, beginning balances are given. So, beginning balance of the common stock is given. Then, additional paid in capital. Then, retained earnings is added. Then, other comprehensive loss. What is the loss? Of 60,000. So 2515 is my beginning equity. Now during the year, company issued additional shares. How much did we issue additional shares? $300,000. Then reported net income of 4,10,000. Then again income should also be added. Then declared dividends of 90,000. From this we are going to reduce the dividends declared, because dividends declared, that means we are paying the money to the shareholders. So this will be removed. Then recorded other comprehensive income of 22,000. We should add the other comprehensive income. So 3157 again, that is also we are getting as the correct answer. So what did we do? We just do as per our concept, that we first of all calculated our current beginning equity. Beginning equity was calculated as 2515, and in that what all components were given, we adjusted them accordingly in our balances, and that's how we got the final answer. Moving to the question number 31, a company discloses in its notes that it is a defendant in lawsuit where an unfavorable outcome is reasonably possible but not probable, and the amount cannot be reasonably estimated under US GAAP. This contingency should be. So under US GAAP, I don't know if you guys have studied this concept or not. So under US GAAP, if there is going to be any loss in the future, and we know about this loss, so usually what happens, like there, if someone has done a lawsuit against us, if there is going to be a lawsuit against us and there is a reasonably possible and it is also probable, that means there is a very high chance that it's gonna happen, and we also know that what will be the amount, and the amount is also reasonably estimatable. In that case, what do? We accrue that particular amount as a liability. That means we show it as a liability on our balance sheet. But if it is reasonably possible and it is not probable, and also the amount of which the liability will be there is not sure, then we do what? We do not accrue the liability. We just simply show it under the notes to financial statement, explaining that this is the scenario. We are not exactly sure about the amount, and also we are not sure the probability of this happening. So that is why we are disclosing it over here. Once we note the amount, then later on, maybe the next year, we will show it as a liability. So which option should be the correct? Accrued as a liability on the balance sheet at maximum possible loss. We don't know the amount only, and it's also not probable, so we are not going to accrue it. Option B, disclosed in the notes only with no liability accrued. Yes, this is the correct answer. Option C, ignored entirely since no reliable estimate exists. No, we are not ignoring it completely. We are showing it on our notes to financial statement. Option D, accrued as a liability at the midpoint of the possible range of loss. Is this something we should be disclosing it as? No, we should not be like accruing it like that. So again, only option B is the correct answer. That is the correct treatment. Then the last question, which of the following pairs of financial statements are most directly linked in that the ending balance of one statement's key output becomes an input to the other? So which of the two are the pairs of the financial statements in which one of the ending balances of one of the statements will be one of the components in the another statement? Let's have a look. The statement of cash flow and the statement of comprehensive income. Does anything from statement of cash flows goes to the statement of comprehensive income? No, not at all. Then the income statement, net income, and the statement of changes in the stockholders equity. So is this correct? Yes. Why? Because the net income goes where it is added to the retained earnings. Retained earnings is reported where? In the statement of changes in stockholders equity, and also in the bracket it's given net income and retained earnings roll forward. So that is why this is the correct pair. This is the correct pair because net income will flow in the retained earnings. Then let us see why option C and D are incorrect. The balance sheet and the notes to financial statements. First of all, notes to financial statement is not a separate statement. So this is anyways a useless option. It's not the correct answer. Option D, the statement of comprehensive income and the notes to the financial statements only. Is this correct answer? No, this is not the correct answer. Why? Because the statement of OCI and again the notes to financial statement, these are not the statements only. So anyone who has clearly understood the notes to financial statement, when they will see option C and D, they will immediately eliminate it. And once they see that okay, in the bracket net income and retained earnings is given, and they will read it once, and then they will clearly mark it option B as the correct answer. I hope this was clear to you guys. If you have any questions, any doubts, please feel free to reach out to us and we'll be very happy to help you out, guys. Thank you so much for staying out.